Okay, so in this video, we're going to talk about HEXO stock. This is another cannabis stock that is trading on the New York Stock Exchange. So this one is also facing delisting status. The stock price has currently been below $1 for, let's see, the last time it traded over $1. So it's been below $1 for about 3 trading sessions now. So the rule for New York Stock Exchange is that it has to be below $1 for 30 consecutive days to face delisting statuses. So since you guys just told me to post a video on this, I figured I'd talk about HEXO stock. So I'll just give you guys a quick breakdown of the company. HEXO Corp engages in manufacture, production, and distribution of medicinal marijuana. They're based in Canada. So this is actually one of the smaller cannabis stocks in terms of market cap. As you guys can see, it's only 196 million market cap, so much smaller than companies like APHA, Canopy Growth, and Aurora Cannabis. So this is actually a company that I've been watching for quite some time, and one of the reasons why people aren't as interested in this stock is simply because the revenue just isn't very high. So if you take a look at the revenue for HEXO, it's only $36 million. That's actually not a lot compared to companies like Canopy Growth or Cannabis, which are doing the hundreds of millions of dollars. So since you guys asked me to make a video on it, I figured I'd talk a bit more about the company. And the first thing I wanted to do is wanted to give you guys some insight into their latest quarterly report, because I think it provides a lot of useful information. So they actually just reported second quarter fiscal 2020 financial results on March 30th. So let's just read some of the reports. I like to read those key highlights and of course what the CEO says, and then any major changes. So it says net revenue increased 17% to 17 million. Adult use grams and a gram equivalent sold increased 57%. So that's a great jump in production. And production levels increased 22,000 kilograms from 16,000 in the previous quarter. So really with HEXO, they have a really strong brand called Original Stash, and I'm going to talk a bit about that later when I show you guys exactly what it is. I go on the website, but let's just finish going through the report. So now I'd like to see what the CEO says. We've continued to focus on improving our operations, expanding distribution across Canada. Our strategy with Original Stash is demonstrating we can directly compete with the black market. The industry continues to see challenges ahead, and following strategic review of the company's core and non-core assets, we believe we have positioned HEXO to meet these challenges head on. So with a company like HEXO, the biggest problem they have is 2 big problems. Number one, getting their revenue up, and number two, dealing with cash burn. And that has been one of the main concerns for this company. People and other analysts and things like that are wondering if the company can even stay afloat due to all of the money that they're losing. So you guys take a look at the total net losses, quite a bit. That's quite a lot of money, 298 million in total losses. So that's way above their revenue. But the good thing is that their production is increasing. So what I like to see from cannabis companies, I told you guys about cash cost per gram, and also you want to take a look at numbers like gross revenue per gram. So one of the bad things about HEXO is that, as you can see here, gross adult revenue per gram has decreased. So basically what that means is that that's the wrong direction you want to go in. And I talked about APHA in a video that I posted yesterday. APHA is actually increasing their revenue per gram. So that's really not a good sign for HEXO. And one of the reasons why companies are decreasing their revenue per gram is because they're basically selling cheaper products and trying to kind of compete with the street sellers, which I think is a mistake, because I think in the long run, I think the street sellers will be pushed out of the marketplace altogether, and they'll end up doing something else, because I don't want to see a cannabis company kind of, I would say commoditize their product, because there is something special about medicinal and recreational cannabis that you purchase from a licensed provider. It's just different, because guys, if when people buy things on the street and stuff like that, you really don't know what's in it, and it could be laced with something else. So I don't like companies that are kind of cheapening their products. I think if you're selling an original product, I think if you're selling a product that's licensed, I think if you're selling a product that's pure, that you should be able to increase your prices, not decrease them. So that's not a good sign for me from HEXO. So we'll just read some other things that's going on in the company. Operating expenses have increased a ton. and they need to do a lot of restructuring and things like that. But not the best report, guys. Numbers aren't as good, and there's also a pretty good article posted on Benzinga that talks a bit more about this, kind of goes more into the accounting side of things. Now, for companies like this, when I'm looking at cannabis stocks, I'm kind of lenient sometimes if they're not earning, a ton of profits, as long as that revenue's there. So the problem with Hexo is that the revenue is not really good, only 36 million, and they're spending a lot of money. So as you can see here, the most important factors in Hexo's second quarter report were no improvement in cash burn, lower gross profit per gram, and worsening operating cash flow and sales ratios. So biggest thing these analysts are looking at is they're all about profitability. For me, I'm a bit longer term. I'm not really involved in hedge funds or things like that. So I'm willing to wait a few years to see those profits come, because I know if that revenue's there, that they can figure out a way to make it. But, as you can see in the report, it just talks more about how the company needs to minimize their operating costs and things like that. And he sees greater problems with cash flow. So the risk of further dilution, lack of meaningful and sustainable sales improvement, low gross profit per gram, and ongoing cash burn make us underweight. So those are some of the things I agree with as well. I'm not so much worried about the profitability. For me, it's just the revenue's not there, and they're decreasing their costs to compete with street sellers, which I don't really think is a great long-term strategy. So if we take a look at some of those brands that they were talking about, I want to show you guys the original stash. That is like their new brand that they came out basically to compete with the street sellers. Okay, so let's talk a bit more about Original Stash, because this is the product that's been lowering their average revenue per gram, but apparently they think that this can basically push out the street sellers. So it says Hexo recently brought its house of brands to crew Original Stash, a mass market brand that goes back to why we consume cannabis. For the simple pleasure it gives us, Original Stash focused on frequent Canadian cannabis consumers who want quality cannabis but are conscious of legal market premiums. So under our Original Stash brand, Hexo continues to disrupt the market with first product offering of its kind, 28-gram blend of cannabis flower. This volume is the first of its kind in the legal Canadian market, and Hexo's cannabis consumers. So guys, when you saw those numbers, the average revenue per gram coming down, that's because of the Original Stash brand. So this is basically the solution to get rid and eliminate the street sellers in general. And most of these products, when you see cannabis products and medicinal marijuana products, most of these products are sold at a big premium due to taxes and things like that. So it's actually cheaper to buy stuff on the street right now. So this is kind of their solution to get rid of the street sellers. So although it is lowering that average revenue per gram, I think it is pretty interesting and a pretty bold approach. Will they be successful by coming out with a cheaper product that basically takes all that money that was going towards the street sellers, and people want to invest it in a brand that they know is clean and pure and not like laced with anything or something like that? So that is interesting. It seems like it's hurting the company financially in the short term, but perhaps this is their strategy to acquire a bigger market share. So even though I don't really like the stock right now so much, I want to monitor this Original Stash because I think it's a pretty catchy name, and it's interesting. It's an interesting concept that I want to keep following. So as we also look, they also there's a medicinal unit. So they have 30 dry products. This is their product line, things like that. So they have won a couple awards, which is nice to see. So the company does have some potential. I just think there are better options out there. So as you can see, and also they're doing a majority of their sales within these parts in Canada. So it says in October 17, 2018, Canada became the largest nation in the world to offer medicinal and non-medical adult use cannabis nationally. So Canada is a huge market, guys. So there are a lot of players that are going to benefit from the Canada market. So Canadian market. So basically, this is a toss-up. But for right now, I'm just interested in monitoring Hexo. I want to see if it even survives the delisting status and stuff like that. And then I can show you guys they have adult use and medicinal products as well. So the company The company has potential, I would say HEXO does, but it just doesn't seem like with all the other options that you have in the medicinal market, in terms of cannabis stocks and cannabis REITs and biotechs, I just don't think HEXO can really compete on the same landscape as those other three I mentioned. So my three favorite are Canopy, Aurora, and Alfrea. And then I think after that, there's a big drop off. But there are some positives about HEXO. One of the positive things is that they are partnering with Fortune 500 companies, and that they do have one of the largest licensed cannabis uh, companies in Canada in terms of square footage. They operate a 2 million square foot facility in Ontario and Quebec, and they have some distribution in Greece. So Greece obviously not as good as Alfrea, which Alfrea is based in Germany. Germany is a much better European country to be based out of than Greece. But Hexo seems like a company where they're struggling. It could be a good long-term investment, but if you're thinking of just basically putting your money in all of these cannabis stocks, you're pretty much better off buying a cannabis ETF like MJ. So you guys can pick that up. If you just want to invest in the cannabis industry in general, you guys can pick up the ETF under the ticker symbol of MJ. So that's kind of wrap things up for Hexo. Really don't like how they're decreasing their revenue per gram and not really earning that much money. And as you can see here, taking a look at the 1 year stock chart has been down a ton. So for Hexo would probably number 4 or number 5 on my list of favorite cannabis stocks. Like I say, we'll just wait and see here. Not every company is going to be making a ton of money right away. And, we have seen a rise in cannabis sales due to the coronavirus epidemic. So for me, this is basically a wait and see. I want to see what's going on with that revenue per gram number. But for me, this is a stay away. Like I said, it's cheap though. I mean, it's cheap enough. If you guys wanted to take a gamble or something like this, by all means, make sure you do your own research and things like that. The market cap is so low that, if things turn around for this company, there's a lot of upside there. So $196 million market cap. But another thing that worries me about the company is that the stock price is at only 72 cents. So now we have to worry about potentially getting delisted. And with those numbers, that could be a strong possibility, as I don't see many people willing to touch this stock with such bad Q2 2020 numbers. So maybe in Q3, due to the whole rise in cannabis sales, revenue improves, but I still think revenue is going to improve for all of these companies across the board. So you're probably going to see more return, and some of those other stocks that I mentioned earlier, Aurora Cannabis and Alfrea and Canopy Growth. I think those are 3 better choices. But that's just my personal opinion, guys. Make sure you go out there and do your own research. So that's it for now, guys. Thank you so much for watching this video. Be sure to give this a thumbs up and subscribe. And have you gotten your free stocks? I use Robinhood and Webull. I use these 2 trading apps every day, and you can get a free share of stock on Robinhood if you sign up using my link in the description. You can get 2 free shares of stock with Webull if you sign up and deposit any amount. So that's it for now, guys. Be sure to stay tuned for more videos on Hexo, cannabis stocks, and just the other stocks that you guys tell me to make videos on. You guys tell me to make a video on a stock, I'll do my best to do my research and give you my personal opinion. So that's it for now, guys. Thank you so much and take care.